Is one, you mentioned inflation. I think the real risk here is growth, because I think now we know what inflation is. We know that it can be sticky, but I think growth is going to be, I think, a big issue. We have a credit crunch, which I think is going to hit the economy, not only in the U.S. Valuation of markets is actually not that attractive. So I think it's going to be quite difficult, but I think we have to be optimistic as always.
So everybody's picked up on this FactSet report suggesting earnings will be revised down about 7% through the second quarter here. Is that enough, given the deceleration that we all acknowledge, I think, is taking place at a macro level?
I think the analysts are still quite, I think, a little bit too optimistic, because you have nominal growth that is collapsing. You have margins that are probably under pressure because of a lot of things. And so I think that earnings will probably disappoint, but my impression is that everybody is positioned for some kind of disappointment. So the risk always when the earnings season, everybody expects earnings to be weak. They're weak, but actually they're not as bad, and markets tends to rebound. So I think we have to be careful to see how the market will take these earnings that I think will be clearly quite negative, because it's difficult to expect anything else.
Can I pick up on the tightness of credit story? Because if you look at it through the lens of the United States, you've had money sitting on deposit at many different banks across the board, not at the major ones. You've seen this huge dispersion of money just sitting there waiting for, I don't know what, effectively. Now that's changed, where those who had the money there were simply saying, well, we need to put it somewhere safe if it's not guaranteed now, and we can get higher returns. That's quite a different story from here in Europe. So how do we think about that credit crunch story as a US story versus a European or a global story?
First of all, let me say that the liquidity crunch is probably kind of over. I think what we don't know is what banks, especially the small banks, will do. You have basically your depositors that are kind of running away, or they've done it. It's much riskier to lend, especially in some parts of the economy. Let's say commercial real estate is one. So I think it's pretty clear that we are going to a period of a big decline in credit creation. The question is this kind of the end of the US economy, or will be just bring a little bit of a slowdown in an environment that is still relatively solid? So I think that US economy will suffer from that more than Europe, but we're not expecting a recession or a significant recession. We're going to see clearly a slowdown going forward.
In that context, then, what do we want to avoid? Because there's some areas you'd imagine small businesses might find it a little bit tougher to access credit. Does that mean you put, some danger signs on, say, the Russell 2000? Are there other areas that you want to be chasing, like technology, which has been a trade in recent weeks? How do you position around this credit crunch story?
I think there is some value now in U.S. Technology stocks, I have to say. We have been quite bearish for quite a long time now. I think we see some value. Bond yields are falling. I think in the small caps is a tricky one, because they've already been declining. So I think the area which I feel more kind of scared about is cyclical sectors that continue to be very solid on the expectation that growth will accelerate, when actually all the evidence is for growth to decelerate. So all this cyclical value part of the market, this is where I think the risks are. And I have to put this also, by the way, European stocks that are typical cyclical value trade.